All right. My name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible by keeping them out of jail. So today I wanted to talk about the importance of gross margin when evaluating the performance of your business or any other business that you're taking a look at, investing, acquiring, whatever have you in business. And I wanted to bring this up because most folks may consider top line revenue. They say, okay, I increased revenue. I brought in all this money, and they think at the end of the day, that's the amount of money that they have to play with to either pay their bills, grow the business, whatever the case. And it's not quite the case because in most businesses, you perform a service or you sell something, there is usually a cost involved with delivering that good or service. And this is what's called our cost of goods sold. So for example, if you are selling an item for $30 and costs you $10 to produce, make, or buy that product to sell, then your cost of goods is $10. You sold it for 30, and what we call gross margin is actually $20, right? So the 30 less 10 is 20, and that's what's called our gross margin. So that's important to know because when you're evaluating or planning how much money you have to bring into your company to do something, again, whether that be pay bills, whether that be grow, whether that be to pay down debt, you really have to look at your gross margin versus the actual revenue is. Because if you're trying to raise a certain amount of money to do something and you're selling these widgets for say $30, it costs you $10 to sell those widgets. Every widget sold is actually $20 into your business, not 30. So it's quite important to know what those margins are. And it's also a good measure to know what this margin is to determine whether A, if you're selling your goods or services for enough, and then B, if your costs are too high or costs. So it should be one of those things. Look up. The data is usually out there as far as determining what your average gross margin should be in your particular industry. So that might be something that you're going to want to take a look at and determine if you're in line. It's a good indicator to determine whether your costs are in check or if your pricing is appropriate, because it can tell you a lot about the performance of your business. Maybe your price is too low, maybe your cost is too high, but it's a great indicator of how the performance should be. And then also you can take a look to see if your costs are in line. You're outside of the industry norms or industry standards. It could be a good way to determine how you may need to fix your cost structure. So that's just a quick hit for today. You want to be mindful of cash flow. So look at gross margin. It's a great indicator of cash flow, and it's a great indicator of where you are as far as pricing and costs. All right. So that's all for now. Hope this helped. If you have any more questions about this topic or any other tax accounting related questions, feel free to reach out. I'm happy to help. That's all for now, and I'll talk to you next one.